Tonight's special report: the Credit Union Cartel, Profiteers of Tax-Exempt Banking. The exception granted to credit unions by Franklin D. Roosevelt in 1934 was part of the New Deal following the failure of approximately 9,000 banks during the Depression. The banking industry recovered, but what went unnoticed for more than half a century thereafter was the long-outlived purpose for granting tax-exempt status to credit unions. As a result, the number of credit unions seeking to profiteer from tax-exempt banking has exploded. Today, this cartel of tax-exempt bankers totals approximately 9,500 institutions with collective assets of about $2 trillion and net revenues in the tens of billions annually, in which no federal taxes are paid. The failure by legislators to strip this cartel of its unjustified tax-exempt status has caused the rest of society to shoulder more and more of the tax burden. The credit union cartel uses tax-exempt banking revenues in numerous lobbying efforts to preserve its unjustified tax-exempt status, because they know it's no longer justified. The absence of any justification lays bare the real reason, best articulated in a quote by author Garrison Wynn, who said, "All I ever wanted was an unfair advantage." When banks object to this unfair advantage, the credit union cartel suggests that banks convert to credit unions and join the cartel in shifting more of the tax burden onto the rest of society. Unlike banks, the credit union cartel is also exempt from the Community Reinvestment Act that encourages lending in low to moderate income communities. In the world of banking, credit unions have become the proverbial pigs in George Orwell's Animal Farm, who argue all animals are equal, but some animals are more equal than others. We have to ask, have credit unions been gaslighting the public for more than half a century? Credit unions argue that to join a credit union, you have to qualify for membership. However, that's a red herring argument for tax-exempt status, because businesses like Costco and others require memberships, but don't enjoy tax-exempt status. The qualifications for membership in many credit unions also appear to be of dubious merit. For example, many of the largest credit unions have what are called community-based membership charters that, I kid you not, only require that you be located where the credit union is located. Other credit unions require a common interest or bond to join, as if customers of banks and businesses like Lowe's, Home Depot, and others don't have a common interest or bond. If you still can't qualify for membership in a credit union, but have someone in your family who does, then you qualify. If that still won't do the trick, you can join one of the many obscure nonprofits listed in a credit union's charter that will qualify you to join that credit union. In other words, the barriers to becoming a member of a credit union are no more stringent than the barriers to becoming a member of the members-only jacket club. Credit unions argue they're not for profit. Despite being tax-exempt, most credit unions must still file a tax return of their financial activities with the IRS called Form 990. On that tax return is a line called net revenue, the not-for-profit equivalent to, you guessed it, profit. As ancient Greek playwright Sophocles said, "Profit is sweet, even if it comes from deception." Also listed on a credit union's IRS 990 tax returns are the names and salaries of its most highly compensated employees that tax-exempt status subsidizes. For this reason, IRS 990 tax returns are an unmentionable topic of discussion at credit unions because if rank and file employees discover what some are being paid, it might embolden them to unionize or demand a share in the credit union cartel's tax-free largesse. Credit unions argue their ability to make business loans, unlike a bank, is very limited because the aggregate amount of business loans they're allowed to make is limited to the lesser of 1.75 times their net worth, or 12.25% of their total assets. What credit unions don't mention, however, is that they can buy participations in business loans from each other, which are excluded from this limitation, allowing them to originate and hold a significantly higher volume of business loans than the formula implies, to be more like, you guessed it, a bank. Credit unions argue they're owned by their members, not stockholders. Members in a credit union have what are called share savings accounts that represent their ownership share in that credit union. However, because those ownership shares aren't marketable securities, the owners aren't considered and don't have the same rights as stockholders, and are not subject to oversight by the Securities and Exchange Commission, both of whom could intervene in the event of unlawful conduct by a rogue CEO and board. Credit unions are primarily regulated by the National Credit Union Administration, a federal agency that would likely cease to exist if it discovered widespread criminal conduct sufficient to imperil the credit union cartel's tax-exempt status. Something to think about.